Hey, what's up, guys? I am going to be talking about the anatomy of the candle and how it's relevant for our trading. Very, very fundamental and rudimentary. However, it's really, really important on understanding how to trade when the price is going to be going a certain way. And so understanding the basics of the candle structure is really important. So let's take a look at this here, okay? So we have open, high, low, and close. And what we have on the left side here is a bullish candle, and bullish simply means going high or buy. And it usually is a green candle. A bearish candle is usually a red candle, and that simply means that price is going lower than when it originally opened. Okay. So as we can see, open here is usually at the bottom of a green candle. Okay, is at the bottom. That's where prices started. Then price typically goes up and down, and depending on whatever time frame you're on, that's when it will close. So as it opens here, forms this line here, and then it goes down. This is as low as it goes. This is called the shadow, and also the wick. This is as low as it gone, and it goes up, forming the shadow. It goes all the way up to here, the high. And then as time is still going, it goes down, forming a wick, and then it closes here. Same for bearish, except opposite direction. It opened here, and then it went in reverse. This is as high as it went. It formed a shadow or a wick. Then it goes down as this wick is going, and then it forms the body, and it comes all the way down here. And before it closes, it goes back down and it closes here, which causes this wick here. So we're going to look at a live example here in this next slide. Okay. All right. So I just kind of drew this in. As the candle is forming, it opens. This is a thin layer piece of candle here. And it moves. It kind of goes up, down, and then it goes down. This is the lowest it's been. Let's say we're in an hour chart. This is as low as it's been, and it begins to go up. And as it goes up, it forms a candle, and it forms this candle saying that, hey, price has gone this low within this time frame. And as price goes up, it hits a high. And then as it goes down, then that's when that candle starts to form. And right before that time is up, or that hour is up, it closes at the top, and then it moves over to the next candle here. And it forms this beautiful body here with these wicks. The same in a bearish candle, okay? The candle opens, and as it goes up, it's actually green. So whenever price goes opposite of the open, it goes green. Or when it goes up or higher than the open, it turns green. It went all the way up here, then it starts to form this wick. It goes back to the open area, and as it goes below the open area, guess what? It turns red. Comes all the way down, and it starts to form. It comes down here, it goes back up, and it starts to form this wick, and it closes here. Once that hour is up, it starts a new candle. All right, so let's go ahead and look at a live chart. And I'm going to show you this example here. This is the US dollar, Swiss franc. I have it on the minute time frame, so that way we can see the candle transition pretty quickly here. Looks like price isn't doing too much. Okay, so here's a red candle. I'm going to give you some visuals here. All right, price opened right here, and you can always know when it opened because there's a smooth line from the previous candle to the current candle. You see that line? This is where price opens. So if it goes higher than this line, the candle turns green. You can tell price has gone here. Price has gone there. That's as high as it's gone within this 1 minute time frame. And then it started to go down. I have a ticker here. Now the new candle's about to change. Another candle's about to form, and there it goes. So the red candle closed here, and it opened here. So when it opens, if it goes higher than the open, it turns green. If it goes lower than the open, it turns red. So I have a timer here. So every 60 seconds, a new candle forms. And you can see it's at 36, 35, 34, 33, 32. Okay. And this tells me that price has gone as high as this arrow, this wick here. Okay. And we're seeing the candle form up. So now it's even higher than the wick. So it's going to form a new wick if it goes down. And we're just watching the candle do its thing. And this happens on every single time frame. Every candle represents 60 seconds because I have it on a minute. If I change it to the hour, every candle represents 1 hour. And that's really important when you're trading, is to know which time frame you're in, and how you trade will determine which time frame you're going to be in as well. That's another video, and I'll touch up on it a little bit just for the purpose of understanding how a candlestick is formed. Okay. So now we're seeing two wicks. Here's one wick. Okay, here's one wick, the lower shadow. So that means price has gone this low. Okay, and price has gone this high. Okay, we have 18 seconds before this candle closes and it forms another one. And we're going to look at one more example, and then I'm going to talk to you about how these candles, how you can identify where price is going by simply looking at candles. Okay, so we have 2 seconds, and now a new candle is going to form right here. Oh, not right here. So right here where it's ending off. So there's a smooth transition. See where I put that red line? You see how that line touches this line? That's where it opened. So if this candle of price on the right hand side, let's move it closer to the price here. Here's the price right here where it says 0.90631. So whenever price goes up above this red line, it's going to turn green. And all the green candle means is that price is higher than when it opened. That's it. If it turns red, that means price is lower than when it opened. Very, very simple to understand. Okay, so we have 8 seconds, and price should be ending right here, and a new candle is forming. See, smooth line right here. Now price is lower than when it opened. That's why it's red. If it goes above, it's going to go higher. It's going to turn green, and then there's going to be a wick at the lowest part there. Okay, so what I'm going to do now is zoom out a bit, because we're going to identify how candles can tell us when to buy and when to sell. Now, nothing in trading is 100% guaranteed, but the odds are really spectacular. So let's go ahead and zoom out a bit. So remember, each candle represents 1 minute, because I'm on a 1 minute time frame, right? Okay, I'm on a 1 minute time frame right in this corner. Okay, so typically long wicks means that price is going to go in the opposite direction of that wick. Okay, here is a long wick right here. You see that wick here? It's pretty long. So if I zoom in, okay, it's a pretty decent wick. Now there's also longer wicks, but here's a long wick here, and it's not 100% proof that this will happen, but it's a good thing. It's pretty good. It works, I would say, 80% of the time. So when you have a long wick, it means that sellers in this case is starting to lose some steam, and buyers are taking place. So we can clearly see a price is going up from here. And here's a trend line just so you can see visually that price has gone up. So wick rejection, that means within the 1 minute time, sellers tried to get momentum, but they didn't have enough time or steam to go further. So buyers was in control. And as you can see, it's gone up. Now here's another long wick here. And you can see that it didn't continue to go down, or it continued to go up. I'm sorry. So whenever you see long wicks, it means that it's going in the opposite direction. Sellers don't have steam. Okay. All right. And here's a long wick here. That means buyers exhausted themselves and they couldn't hold their momentum. Another one, long wick in the opposite direction. They couldn't hold their momentum. So guess what? From the top of this all the way down here, we see downtrend. We can see if we bought up here where we noticed this long wick poking out, we would have made some pretty good money. Okay. And oftentimes where you see we see a long wick here. Now, before you say, there's a long wick here, but it didn't buy. Now, if you look, that's why we also look at the size of the candles. We see many candles here. We see small candles here. That means there was a small session of brief indecision between buyers and sellers. So usually it will consolidate, and you can see how price went up, 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 and then down, down, down. And when it got here, it started to go sideways. And so that's when the candles get small and buyers and sellers don't really know what's going on. And then it started to go down. Okay. So number one, I want you guys to write this down because this is important, really important. How to determine where price is going. Now, like I said, 100% of the time, these things aren't accurate because in like anything, there's nothing 100%, but it's a high probability. We're talking about 75 to 90%. Okay. So wick, long wick rejection. Okay. When you see long wicks, here's another one. It typically means price is going to reverse. Now, how long is it going to reverse? That's another topic. So, but I'm just telling you, just for the sake of the anatomy of a candle, that it's important to know long wicks means it's going to go down. I'm not telling you how long because that's another subject, and we've made many videos of how to determine where to put your stop loss and how to take profit. But for the sake, we're just talking about candles formation. Okay. All right. So we have long wick rejection. And then number two, we're going to put the size of the candle. Okay. So take notes. The size of the candle typically lets us know how or which way price is going. Okay. So if a candle is getting smaller and smaller, that means that buyers or sellers or whichever way the direction of the candle is going is starting to lose steam, and the other is starting to take place. So in this example, I like to go into a higher time frame or a higher chart here. I'm going to delete this to make this a little better. So let's go to the daily. Okay, I need to adjust this. All right. All right, so I'm just going to leave this here so you guys can see. Okay, so typically candle starts to get smaller when price is going to reverse. Okay, now wicks tells a better story than when candles get smaller, but you'll see sometimes when candles get smaller. Okay, so here's some wicks here. Here's a wick here. As soon as it hit this long wick, it starts to reject. Here's another wick here. It started to reject and go the other way. Here's a wick, went the other way. Okay, so we see that, and then here's a long wick here. Start to go the other way. So I'm going to find an example as candles start to get a little bit smaller. And usually you see this in bigger time frames. All right, so we see wick rejection. If we don't see as candles going smaller, we look at the wicks here. Okay. All right, we can see how the green candle is pretty long, and then we see long wicks here with small bodies. It starts to get bigger and bigger, and that's how you know it's starting to reverse. Okay, so we see a cluster. We see this cluster here of green candles. Okay. Okay. All right, so we see how the candle is big, big, and it kind of gets a little smaller here. And that means buyers is losing momentum. And then you can see sellers start to take over. Okay. But the key indicators are these long wicks. That means that there's usually a tug of war. Not a tug of war, but this usually means that sellers or buyers are starting to lose momentum and it goes down. Or the wicks means sellers are starting to lose momentum and it goes up. Okay. So very, very important to understand. Be sure to take notes on this. How to determine where price is going. We're looking at long wicks. You will see on almost every chart, if you see a long wick, price starts to go the other way. And then when candles get smaller and smaller, we see a smaller candle here. So it gets from big to small to medium, and then it gets small, and then it starts to reverse here as well. It's best to look at the larger time frames when determining this as well. But when you're looking at the larger time frames, that simply means that we are going to be in the trade for hours, for days, or even for weeks. So if you're an intraday trader, you're going to stand for about the whole day or so. Scalping for a few days. Position trading sometimes even for weeks or months. That's pretty good. Intraday trading and even swing trading, you're in for days or for weeks. And so when you're doing that, it's important for you to go to the bigger time frames, because I like to use this analogy. The higher time frame you are, the higher in an airplane, the higher you are in an airplane, you're looking down and you can see the bigger picture on Earth. Just like in the daily time frame, you see each candle represents one day in time. So as I look at each candle, it means this is today, yesterday, the day before, and so on and so forth. And here's my calendar here. Down here, I'm all the way back into June of, let's see. Yep. So I'm all the way back in June of last year. And if I keep scrolling, I can go even further. All right. And if I go to the weekly, now I'm zoomed out even more. And now I'm all the way back in 2015, 2014. Okay. So I can see the bigger picture, and this sets me up for a good scalp or good position trading. And your risk is a lot lower because I get to see how low price has gone back in 2014. So if price goes back here, we're currently here. And if price continues to go down and it hits this level here, I'm going to draw a line so you can see. If it ever reaches this level, it's a good chance that I can buy, because we see price in this area has been high for quite some time. Okay. Another good thing to understand is price on the right-hand side. Okay. So let's look at the pair, and this is fundamental here. Let's look at the pair. We're at the US dollar and the Swiss franc. The first pair represents what chart we're looking at. Okay. So if price is going down from here to here, that means the US dollar is losing strength, because we're looking at the first pair. US dollar, price is going down. US dollar is losing strength. Okay. Same in reverse. If price is going in the opposite direction or going up, that means the US dollar is gaining strength. Okay. And that's pretty much what that means. So here is a trend line here. So from here to here, the US dollar has gained strength. Okay. Now this chart represents $1. So the US dollar, because we're looking at the first pair, it represents 1. The Swiss franc is the price on the right-hand side. Okay. So let me zoom in and I'll show you exactly what I am talking about here. Let's delete this and make it a little cleaner, because it is a lot of things on this chart and I want to make sure that you guys understand. Okay. So we're going to zoom in here. Okay. So price is currently right here. It says 0.906. Okay. That means it is 90. And then that 6, you round up to the top, and that makes it kind of like 91 cents. So 0.91 cents, in other words. Okay. So it's 91 cents of Swiss franc for every 1 US dollar. Okay. And sometimes if you don't know or you forget, you can always go to Google And let's type in USD for US dollar, CHF for Swiss franc. And the first thing that pops up is, hey, it costs 91 cents in the Swiss franc to equal one United States dollar. And that lines up with our chart. Okay. So that simply means that if I live in France and I have 91 Swiss franc and I want to go to United States and I want to change my money so I can start buying in the United States, they would give me one United States dollar for every 91 cents of Swiss franc. So that's what that means. We're trading the actual movement of currency and the value of the currency. All right. So that's also important in determining if price is going to go up or down. And it's just like anything else. If something is too cheap, you want to buy it. If something is too expensive, you want to sell it. So if you bought it low, you can sell it high. All right. So for the purposes of this, I want to stick with understanding candles. Look at wicks to determine price going in the opposite direction. Okay. Small candles typically means that buyers are sellers are losing steam. And if it's small at the bottom, that means sellers are losing steam. Okay. So I hope you guys understood what's going on. I hope this helps you to understand. This is absolutely needed in trading successfully. A lot of traders begin trading just saying, hey, red candles mean sell, green candles mean buy, but it's important. Candles are important. All it does is tell us where price is, how much price is within a time frame. Okay. And that's important because it's important to understand that price and time goes hand in hand, just like a dollar isn't worth what a dollar was worth 20 years ago or 30 years ago. So time and money goes hand in hand and is important while trading. All right. So I hope you understood and got some good tips off from this. Feel free to comment, and we hope that you guys enjoyed it. We really, really value you and cherish you, and we want nothing but the best for you in becoming a successful trader. All right. Have a great day and take care.